Welcome everyone to the Kindle Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, hit that like button, and share these videos. Yesterday's action, markets went all in even before Powell actually did his conference. We printed through Tuesday's high with no problem early in the session, and the market stayed positive right into the Fed's announcement and the conference call. As I told you, he's going to tell you everything's okay. They've got your back. The tools that they were going to use, they were going to be used forcefully, proactively, and aggressively. That was interesting. They had forcefully and aggressively in the same sentence, trying to posture the market participants that they're going to do everything they can to support the economy. He also said later in the presentation that the second quarter was going to be the worst quarter in history. We ultimately know, as I've been saying, that reality will come back into the markets and we will see a pullback at some stage. In my live stream yesterday, I discussed something that I think is significant, and what has happened in our economy is the Fed now owns the market. They own all the key markets, the MBS, which is mortgage-backed securities. They're in the corporates, they're in municipals. They're doing lending facilities across the board. He also said something else I thought was interesting. He said that these are lending powers, not spending powers. This is a sugarcoating on what's really going on. They are spending money. It's been authorized by the Senate and the Treasury, which it has. But the Fed is actually executing these plans, which is really interesting. I discussed last night that the Fed is doing a lot of unorthodox tactics as well as violating the mandate. Many of these things that Powell said they're going to do, they are not mandated to do. They're not even legally allowed to do some of these things. No one's going to challenge it because without it, we are in trouble. Everybody knows that. Meanwhile, we're sitting here with the economies still shut down, and finally there's a list of states that are going to come back online. Arizona, where I'm at, is one of them. But when you look at the GDP output of all of the states put together, with the exception of Washington state, most of these states have minimal economic output. They're just throwing up a trial balloon just to see if this thing will float at all. They're going to see how society and everybody reacts in other areas. We've got to get California back online. We've got to get the East Coast back online and other areas in the Midwest where manufacturing and other real things happen in the economy. Without this, we're going to continue to see the deterioration, and the Fed's going to have to do exactly what they said they're going to do, is to be proactive and aggressive in buying assets. It is still hard for me to believe that the market's going to go up to it in a V bottom and keep going higher. But as I mentioned in the live stream on Wednesday, there are some new Fibonacci projections coming out of my models which are suggesting that we could go to a new high here. It's still hard to believe that we'll go straight to that new high. There should be a reaction somewhere, and I continue to believe we're within 60 or 80 points basis the S&P, where the markets will see a reaction. Let's take a look at the charts and see what they tell us for the balance of the week. Taking a quick look at the futures markets, I've been discussing over the past couple of weeks, right before the open in London, we've seen the London traders come in and bid the S&P futures in pre-London markets. The last two nights now, we're starting to experience some selling coming into the London Open, flattening off the markets. Now, the futures were up about 22 handles not that long ago at the peak here, and they've been selling them down. They're stabilizing now, but it's an interesting thing I just want to point out. In the overnight markets, this is one of the things that I always watch for, and how the markets are likely to trade as we come into the U.S. Open. There's a lot going on in this daily S&P chart. Now, this is the cash markets, and I want to point out there's some new Fibonacci projections that came out, and these are significant in that they are projecting the potential for the cash market to go to a new high, just moderately, but they are projecting higher prices out of this pattern. And one of the things that you folks will learn by watching this channel is that market analysis unfolds over time and it changes. It's dynamic. You have to understand what's going on within market trends, and sometimes the corrections that you expect to see do some retracement actually end up to be sideways, and the market corrects while going sideways, refreshes, and then momentum resurges and we go back up. We rally back to a new high in the sequence. And that's what we've been seeing over the past couple weeks. This pattern right here is what I'm talking about, where we got a sideways pattern. We had primary 8 bars within this pattern. I talked about the markets correcting back about 4 or 5 sessions ago, correcting back 2710 to 2660 level. Well, the moving averages that were moving up below that actually supported the market. And we're continuing to see a lot of divergence in PPM1 and PPM2. Now that we've made a new high, we're seeing divergence highs. So this is setting up the tone that this is the final rally. The sideways pattern that we experience has set up this projection of these 3 dots that you see above the markets here. The minimum objective, I will draw on the pop-up window here, is 3340 is the minimum, 3388 and 3413. These are going to be the targets for this sequence to continue. But before we get there, we have 2 other things to deal with. One is the Fibonacci retracement values, and we also have the 200-day moving average, which is 3006.26. Now it's interesting because the 200-day has actually started to decline, which tells us there's going to be a fair amount of resistance here. I discussed several days ago that I did not expect to see a 5-way pattern, but it appears that we have just experienced one. The structure of the 5 waves would be this first wave up into the 21-period moving average, down to into the support level. This would be wave 3. We got an ABC, which is called a running ABC, where B made a new high, and now we're in wave 5. Now the probabilities, and this is where this projections on this Fibonacci numbers are coming out, is that wave 5 could equal the length of wave 1. This is where the projections are coming in at 3158, 3323, and 3425. Those are ratios of the overall pattern. Proprietary indicators actually calculate this based off a pattern recognition system that's identifying these patterns and then telling us where they're likely to go. Now, there's one other number on here. This number right here, which is 3194, is a major pivot number, which is just above the 3158 number. So the ultimate resistance, or the final stand for this rally, could be as high as 3158 to 3194. It's hard to believe that these numbers are coming into play, but this is reality. But there is several things that we have to get through. Number 1, we have to get through the 200-day moving average at 3006. I just put up the Fibonacci grid so you can see where the numbers lie. 0.76 comes in at 3106. So we have a cluster of numbers, 3106, 3194, and the 3158. This will be an incredible resistance point, and we should get a reaction from there. The final element is the monthly graph. Today is the final trading day of April. And if we trade up and stay at these levels we're trading at right now, we're going to be closing at that 2931. So it's going to be incredibly simple to challenge the 3106 level. There's another number there that I want to talk about. There's just an incredible cluster of numbers that come in at this level. The high of March was 3136. There's so many numbers that are clustering around the 3106 up to the 3194 level. There's just yet another number. The high of last month is there. My expectation will finish there. I talked about a couple of nights ago that I still expect to see a big retracement in May. This particular sequence is not done yet. And until this completes, we're not going to be able to see any kind of retracement. So we may actually run into through the first week of May before we start to see turnaround. Because of the magnitude and the divergences that I showed you on the PPMs on the daily chart, there is a risk of an abrupt reversal. It is diminishing every day that goes by that we stay above the 2875 level. So in conclusion, the expectation is for this market to move up into the 3,000 minimum of 3,024 with the most likely targets of 3106 to 3194. I just want to cover gold very quickly. It's acting very well. The last two sessions, we continued to hold the 21 period moving average. And now we're breaking back above the 10, and there's some new Fibonacci projections on gold as well. It's 1879, 1960, and 2010. This is off the daily graph. So we've seen similar projections in a previous pattern set up like this. So this is becoming very bullish. We're starting to see the PPMs turn around. As I've mentioned in the past, this pattern is very bullish and looks explosive to the upside. Gold is still being traded as a hedge against all the catastrophe in the economy in spite of how the equity markets are acting. This is a very bullish pattern. I would continue to be a buyer in gold along this line, and you can stop out just below 1,700. So there's not a lot of risk here to get into gold, and this market should explode over the next several weeks. Thanks again for watching. We'll talk to you tomorrow night.